Good to have you here.
Thank you, David.
All right, first let's start off on that down 29. Sounds like a big number, but there are a lot of different factors involved in why it really wasn't that bad a first quarter.
Actually, I think it's a surprisingly good first quarter in a lot of ways. Yes, down 30%, but that's off a $5.8 trillion market last year, which was $1 trillion ahead of anything we did the previous high, which was 2007. So it's a $4 trillion run rate market, and it'd be the fourth or fifth highest in history. So, you know, if we maintain this, it'll be a very good market.
Yeah, all right. Maintain is the key point. And there are any number of things that could conceivably put the brakes on it. Let's start with regulatory regime. We talk about it so often here. It came up a lot yesterday in this JetBlue potential bid. You know, the DOJ, not to mention the FTC, seem very much focused on even keeping companies from thinking about announcing a deal. Are you seeing that? And if so, where does it play out most prominently?
Look, there's clearly a change in the approach to antitrust in the Biden administration. I think that's, you know, unequivocal. I would say what we see at this point, duration of transactions, particularly large ones, things that touch the consumer, healthcare, technology, you know, pushed out 18, 24 months or beyond. You're in a more uncertain environment. So I think the prospect for mega deals, 20 billion and up in North America, is probably somewhat reduced because, look, it's unclear ultimately when a number of these cases get tried in court, which I suspect they will go to, particularly with new approaches away from consumer behaviors or harm standard to anti-competitiveness, looking at oligopolistic market structures, bigness being bad. I think we'll see a reduction in those kinds of transactions. We had a couple in the first quarter in North America, but it's going to be lower.
Well, we had Microsoft, Activision, for example. But you do think, I do wonder, you think some of these companies will be willing to go to court because conceivably, to the point you're making, they may be relying, that is, the regulators, on perhaps legal theories that have not been tested.
Correct. Look, I mean, that's the question. I mean, I think in an uncertain environment like this, the question is, and what I'm seeing is a shying away from from mega deals at the moment. That's not to say we won't see a few.
Right, but why do something that's going to take 1.5 to 2 years, and I might have to go to court?
That's very much the argument. And I think what we're likely to see is transactions sub 10 billion. Call it, 3, 5, 7, roughly 1 to 10 broadly defined. That where I think is going to be the sweet spot in this market, particularly in North America. Now, we saw a $60 billion transaction in India this week, the big bank deal. So it's not to say, that these things can't happen. But I think it's certainly a higher standard at the board and the CEO level, given the duration, given the posture of the administration, and so on and so forth.
Yeah, well, all right. So, 6 to 8 to 10 billion, not small. Obviously, a few years ago, that would have been considered fairly large. Private equity continues to play a very prominent role. In fact, today, the only real deal I talked about was the CDK deal, $8 billion enterprise value. Mm-hmm. Do you continue to expect private equity to be very active? And give me a sense on the financing markets, which there have been some concern about recently.
Sure. Look, I think you got to look at, to me, a big driver of this market is liquidity. And by our count, there's over $2 trillion of capacity in the private equity world at the moment. And you got $2 trillion of cash on corporate balance sheets. That's a massive amount of liquidity. And liquidity tends to, does have a big impact on driving transactions. Sponsors in the first quarter were a little over 30% of the market. Consistent, slightly lower than the fourth quarter last year, but a very healthy percentage. Look, rates are going to go up. So that's going to raise your weighted average cost of capital. Does that bring down pricing in some respects? You've seen how the shift away and the reset in valuations in some of the growth spaces. Right. But I don't see why, at this point, this is necessarily going to stop private equity. I also think, we're definitely seeing in the corporate landscape sort of a resurgence in activity. Again, not the mega stuff, but we're things like 20% of the market were spins and divestitures last year. So it's pretty healthy at this point, David. I mean, look at the places that, when you think about it, 65% of the market is North America, which is not unhelpful. And secondly, when you look at where the volume, so who's done well? Where were volumes up in the quarter? It was tech, it was, believe it or not, real estate and power. Industrials, healthcare, comms, and energy were down. I think there may be a resurgent bid in energy given what's happened in Ukraine.
Shepard Smith here. Thanks for watching CNBC on YouTube.